You don't have to worry about a financial crisis until the banks start rolling.
Hey, this might be the start of a serious banking crisis. We should look at the components of this in detail in this video so you know what's going on and where the concerns are. Because even though we had a collapse of Silicon Valley Bank and the essential universal bailout of, well, venture tech bros and politicians like Gavin Newsom and, well, basically every bank by the Federal Reserve in 2023, we might have actually just swept the cockroaches under the rug.
Cockroaches. Private credit further on the defense after a group of academics at Johns Hopkins and UC Irvine warning that the industry's claims of market-beating stress-free returns are illusory.
Absolutely, and I was just out at the
Well, if you look at what happened in the market today, you can see SoFi fell 5%. The financial sector ETF fell 2.7%. JP Morgan down 2%. Regional bank ETF, KRE, down 6.2%. The regional bank IAT iShares ETF down 4.8%. Zions Bank, 13% down. Western Alliance, down 10.8%. And Jefferies, one of the lenders that got caught up in the Tricolor and First Brands collapse we covered just a few weeks ago, $10 billion market cap company, just lost $10.6 billion. And if you zoom out, this company is down over 39% from its highs just after Donald Trump was elected. So what's going on in the banks? Is trouble actually brewing here, or are we going to be okay? Well, let's understand first what was filed. And this has people, well, nervous, understandably so. So Zions Bank says they recently became aware of legal actions initiated by several banks and other lenders against parties that were affiliated with two borrowers under two related commercial and industrial loans. So what you ended up with is you got Zions writing down $50 million of a $60 million loan to these entities. This, mind you, comes after the Tricolor and First Brands multi-billion-dollar loss, with Jefferies taking a $700 million hit. This is a lot smaller. But what's making people nervous is potentially that banks are starting to say, all right, after the canary in the coal mine burst, so in other words, after Zions and First Brands blew up, it's time to cut these loans. We're done extending and pretending. And this is why people now say we could be walking into a dirty and ugly black swan. Look at this. Zions Bank is now filing a lawsuit in California against the parties to try to recoup as much as they can of that $50 million. Though, of course, a similar bank called Western Alliance said that they too were exposed to the same group that Zions was exposed to, and that they're filing a lawsuit against these individuals, potentially for fraud. And this would be a way to bypass the non-recourse aspect of a commercial loan and come after these borrowers personally. So they're trying to come after the high net worth individuals personally to get basically as much debt as they can. And people are wondering, man, we looked up some of these properties. And we looked up like these strip malls right here. You can see it's boarded up. We looked up the ownership of this property, and this has had notices of default circulating on it almost all of 2025. I mean, I certainly saw them back in April. It was notice of default, notice of default, notice of default. They just kept filing it over and over and over again. And you're finding these empty leases, high debt properties, property values falling in office and commercial. And what some people are saying is that post First Brands and Tricolor, the jig is up. No more extending or pretending. In fact, consider for a moment what had been done for years to try to get a little bit of a better understanding of how this whole process works. When you look at the Financial Times and you go to a 2024 article, they said the bills could soon come due for mortgages on commercial properties. And basically, they reference these charts where companies and banks are just pushing 2023 defaults to 2024 and 2024 defaults to 2025. Everybody's kicking hundreds of billions of dollars of commercial maturities down the road. These are the maturity walls right here. 2023, right here, as of the end of 2022, you had about 700 billion. In 2024, as of the end of 23, you had almost $1 trillion. And then you had, yeah, that's a lot. I mean, we're at, billions or hundreds of billions over here. And then you're kicking the can down the road over here on 2025 of another $600 billion. So these are massive amounts of debt walls that just sort of keep getting kicked down the road, which isn't great. Now, the total principal balance of these loans is a systemic risk if you get a lot of these that start taking haircuts. That's why people say this could be a massive black swan. I mean, you're talking about hundreds to trillions of dollars, hundreds of billions to trillions of dollars of debt, that if banks start saying, you know what, we're done pretending, we're just going to start foreclosing, you could have massive collapses in the banking sector.
And the components of those collapses could end up feeding into a financial crisis. But the collapsing banking sector is exactly why people love today's sponsor, Gemini, because you can finally earn crypto rewards with a credit card, and it's great.
Let's be real, most people want to invest, but life often gets in the way. Work, bills, errands, and then boom, the month is over and there's just too much month at the end of the month and your money is still sitting in your checking account and you're like, ugh. Well, that's where today's sponsor, the Gemini Credit Card, comes in. It's the only credit card that gives you instant Bitcoin rewards on every purchase. No waiting, no converting points, no extra step. It's basically like as you're going through your life spending on normal things that you're going to spend money on anyway, probably. You're just investing. You're earning Bitcoin. You are investing into Bitcoin automatically. Here's how it works. You get up to 4% back on gas, transportation, get up to 3% back on dining, 2% back on groceries, and 1% on everything else. All that gets deposited in Bitcoin the moment your transaction clears. You're literally building crypto exposure as you just live your normal life. No trades, no complicated redemptions, none of that. For perspective, cardholders who held on to their Bitcoin rewards for an average, well, at least for 1 year on average, saw a 277% increase in value because, well, Bitcoin's done quite well over the past few years. Now, of course, can't guarantee that going forward. Crypto's volatile, it could go up and down, but it's a powerful stat if you're thinking about the longer term because you're automatically having Bitcoin appear when you use the Gemini credit card. There's no annual fee, and you can see if you're eligible with no impact to your credit score. Go to Gemini.com/Kevin to apply, and when you're approved and spend $3,000 in your first 90 days, that's just $1,000 a month, normal spending, you'll get $200 in Bitcoin. Again, that's Gemini.com/Kevin, or click the link down below in the description. Our sponsor today, Gemini.com/Kevin.
Now, when I was just talking to Ross Gerber at lunch in Malibu, he said, Kevin, you don't have to worry about a banking or you don't have to worry about a financial crisis until the banks start rolling. When the banks start rolling, that's when you want to start getting nervous about a financial crisis, because that's what the name is. Recession, financial crisis, banks. When banks start having problems, that's when you want to pay attention. And look at what we have today. Nothing other than Jefferies down 10%, the regional bank indices down 4 to 6%, Western Alliance and Zions down over 10 to 13%. And it's leading a lot of people to wonder, are the debts of the banking crisis just now finally starting to come due? Mid-cap bank analyst at Wells Fargo stated, when credit risks rise, investors tend to adopt a sell first, ask questions later approach. Jamie Dimon just argued that when there's one cockroach, like First Brands or Tricolor, there are probably more. And this pissed off a lot of people in banking because they're like, oh my gosh, Jamie Dimon, you're bagging on banks. Like maybe you have problems. Maybe you're pointing the finger, but it's really you that have problems. But then people started getting nervous and going, uh-oh, maybe the regional banks do have problems if they're lashing back this hard against Jamie Dimon. And so take a look at this. When you see this headline here, are credit black swans back? Troubles at 2 U.S. regional banks trigger an abrupt V-shaped reversal in the stock market. you recognize, this could actually end up having systemic impacts, broader impacts. So where do people flee when they want money out of financials and into safety? There are two places they go. Number one, gold. Gold is literally up 3% today. This is insane for gold. And it's either absolute FOMO that people have missed the gold run, or it's a sign that there's a major risk. And you potentially have institutions that are like, oh crap, it's starting. Because remember, financial crises start with the banking sector. And the banking sector got saved in 23 by the Fed, but we really just swept the problems under the rug. Now people are flying out of financials and into two considered safe assets. One, gold, and number two, bonds. Now remember, bonds gain price, yields go down. The yield on the 10-year down 7.4% today, which means bond prices skyrocketed today, probably more than gold did. So bonds performed amazing today, gold performed amazing today, and financials tanked, and the broader stock market started having a little bit of a panic as you started seeing the Qs sell off. Now, we ended up the day only down 37 basis points. We're down another 19 basis points in after hours. Bitcoin had a triple bottom that it barely held on to. Ethereum, we can see the pain of Ethereum heading back down to the 3,500 range. And even MP Material, which is a stock that we actually called a top on in the alpha report, saying 100 was a top. It's going to reject. It's highly likely to reject. Obviously, can't make guarantees. But it's been straight down since then. It's down almost 17% since our call that MP Material was topping. You can get those in the Meet Kevin Alpha report. Can't always be right, but you can join us, get that perspective every day before the market opens, and you get our alpha report and you get lifetime access to that. Could even be tax deductible. On top of that, remember, you also, I always think this is funny when the camera does this, you also get access to all 8 courses, all the trade alerts, and you get to see everything that I'm doing. So, something that you really want to watch for now is what happens to all of the people who are quickly trying to sell their real estate in the commercial real estate market. Well, take a look at this. If you go to 1031save.com, this is actually Ben Mala's portfolio. He's been trying to sell his portfolio. It doesn't, if the website is updated, which I'm assuming it is, I'm not actually seeing his commercial portfolio turn yet. But what I am seeing is price reductions, at least that he's listing. Now, I don't know. I mean, who knows? Like, maybe that's just the way they're marketing it or what. But what I do notice is that this fitness center here, which has an address listed, does indicate on public records that it was purchased for $10.9 million in 2019. That was 6 years ago. It is now listed for sale for $11.5 million. And if the loans that were taken out on these properties, I don't know if they have loans, I'm just wondering, but if the loans that were taken out on these properties were interest-only loans, that means principal was probably not paid down. Which means if this sells for much under $10.9, less selling costs, it's possible some of these portfolio properties could end up selling for under what they were acquired for, whether they're hotels or whatever they are. And I think this is why this MoneyWise article here says, business mogul Ben Walla is selling his entire real estate portfolio. Here's why he says banks have gone from pretend and extend to pray and delay. Now that's really interesting because it's this argument that in 2024, we had extend and pretend. Like, we'll just extend the due date on your loan. We'll give you a little bit more time. And now it's, hopefully rates come down quickly because otherwise we're going to hit the fan. And I think now we're in the third inning. So like first inning, extend and pretend and extend. Second inning, pray and delay. Third inning is we're going to start filing lawsuits and foreclosure action against these people. And the fourth inning is the drop. And we've started to see that today in the banking industry. Now, maybe this is a big nothing burger. We do know that commercial foreclosure activity is ticking up, though. Look at the financing data that we have, total U.S. commercial foreclosures as of the end of last year. We don't get recent data very commonly, sadly, with commercial foreclosures. But you could see since 2020, you've basically been relatively flat here on foreclosures. It's starting to tick up. In other words, the banks are done. Why? Probably because credit spreads are starting to widen and people are getting nervous that whether it's due to tariffs or whether it's due to an expensive or high valuation stock market, it's time to take profits. Maybe banks have been at high valuations, so maybe it's time to take profits there, or to start pressuring banks to be a little bit more aggressive in their collections, or fear over what happened with Tricolor and First Brands, that a lot of these loans might just be built up on either fraud, froth, or garbage. Maybe we're in for a bigger problem than we thought. Take a look at this. Summer Street Real Estate has an article on this, and they say that between 2020 and 2022, billions in multifamily repositioning and value-add deals were financed through commercial real estate collateralized loan obligations, CRE CLOs. CLOs became the go-to financing because you could basically chop them up, bundle them up, and sell them to investors at high fees who wanted yields. This is scary, though, because what happens when you start getting defaults? Some lenders are tapping these warehouse lines of credit to finance the buyout of defaulted lines of credit. So in other words, we're taking on debt to bail out other CLOs. Well, what happens when all of the ability to borrow money evaporates and nobody wants to borrow against this junk anymore? And the whole jig might be up, which is scary. You look at Jeffrey's balance sheet. It's not exactly my most favorite balance sheet. And bank balance sheets are some of the most complicated balance sheets to understand. They right now have about $22 billion of bills outstanding, and they have 17.9 liquid. So they don't have as much liquid as it might look when you actually start digging deeper. But I think a lot of investors are looking and saying cash flow is going to start getting hit if some of these loans start rolling over, because all of a sudden you're not going to get repayments on things that you're declaring as assets on your balance sheet. Remember, a lot of these financial balance sheets are built up under here. Investments in, loans related to related parties. That's weird, $1 billion of loans to related parties. Okay. Securities borrowed, securities purchased under agreements to resell, securities sold under agreements to repurchase. You got $12 billion of repurchase obligations here. What happens when you start having to repurchase and the valuations have collapsed? It's not great. So the banking sector is going to be something we have to pay attention to a lot more than I think a lot of the market thought. And remember this, because this might be the critical message. Financial crises start with the banks.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.